Okay, welcome back. Welcome back to another video. This is hey, this is me. Um, and in today's video, we'll be continuing our series of trying to work on accounting questions as students. I've taken this from the advanced accounting book. Do I have it here? No, but I've taken this question from the advanced accounting book on chapter 4, uh, problem 4, like part 2. I don't know how to read it, but in today's video we're going to be trying to solve this one question only. So the question here is about work paper in year of acquisition. So here are the descriptions. I'm just going to try to read it. Liam AB acquired 80% of ownership of Theo. So Liam is the parent, Theo is the subsidiary, I suppose. And so Theo's stockholders' equity is 2 million capital stock and 8 million retained earnings. So the total of 10, right? Theo's assets and liabilities were at book value equal to the fair value. That's another important part to note. And here are the separate financial statements of both Liam and Theo. We can look at this. So these are the accounts from combined income and retained earnings statements and balance sheet from both Liam and Theo. No dividends declared by Theo during the year were paid. Okay. Now what we need to do is to prepare consolidation work papers for Liam, AB, and subsidiary for the year ended. Okay, so I've tried to understand the materials and I've tried to understand the materials on this chapter, and I tried working on these questions. And so what I did to first kind of um, I guess slowly work to solve this question is to first identify like a couple points from the question. First, the ownership of the parent is 0.8, or let me just change it a bit. 80%. Non-controlling interest means that it's 20% because 80% is already owned by the controller, controlling entity. And the purchase price was 10, right? Where do I get 10? I get 10 because of this. Liam acquired 80% for 10, right? Here. And so that's the price if they acquire 80%. Just like before, when we want to calculate, and here we want to calculate the goodwill. And so if we want to do that, we have to find the 100%. So what if the ownership is 100%, not 80%? Then we can just divide this by this, and we should get this. Oh, sorry. We should get this. 12,500. So that's the 100%, and we just compared it with the goodwill. I'm sorry, with the book value of net assets, since they mentioned that it's book value equal to the fair value. So then you'll get this much, and then you can subtract to obtain the goodwill. Now, another thing that I also calculate is the non-controlling interest, which can be calculated by multiplying this, the 100% of purchase price, with the ownership of non-controlling interest, which is 20%. Okay, another thing that I calculated is the non-controlling share of net income. Maybe I should add to this of net income, like that. Okay, so this is net income from Theo. I got it from here, and non-controlling share should be like 20% of it. That's where I get that. Okay, now this information will be useful for when we try to move this and create the consolidation work papers. Speaking about consolidation work papers, here is how you generally want to make it. So first you have the same table, actually, just like the ones from the question. So where you have like Liam and Theo, just like this one. But then when we're making consolidation work papers, we want to add this this bit right here: adjustments or eliminations, and consolidated statements. These two are what we want. Our consolidated statements is like the final product of it, and adjustment and elimination is required, as basically there are some accounts that needs to be either adjusted or eliminated. So to begin, let's start here. So we have sales. Okay, this is part of the income statement. What I want to note down is this, maybe the adjustments on income from Theo. In here, I debit the income, which means that it should reduce because income is an equity account, right? And I also I also like add this in, so then it will reduce the final net income. Okay, so the reason I did this is basically, so Liam has sales and Theo has sales, right? If we combine those two sales, it will become this. They have costs, so each of them incurred costs, and so that's the total cost, and each of them have like maybe expenses other than cost of sales that should go there. And then I adjusted by not including this and subtracting by non-controlling interest. I don't include the income from Theo, as income from Theo here already comes from the sales amount subtracted by the cost of sales and the expenses. And so there's no need for me to record this in the consolidated statement, or else it will just be like double recording, which is not good, right? As for the non-controlling interest share of income, I reduce it because I subject this to reduce um, the net income, because this is basically the share of income that us as the parent company don't have. It belongs to the non-controlling interest share income, and 300 here is obtained from the calculation here. So that's why it was important in the first place. We got this for the income statement. And then for the retained earnings statement, in the case they kind of combine both, but I just try to separate it. So we have the initial retained earnings. It's the same as the case. We have the retained earnings from Theo. We have controlling share of net income, dividends, and all. Okay, now in here what I did is I basically omit this. I eliminate this account, and I don't include the dividends from here. So the reason I omit this account, 8,000 in retained earnings, and then I cancel it by debiting it, is because Theo is a subsidiary and it already belongs to the parent. So the idea here is that when we're making consolidated statements, we're not making two statements of two different companies, but we're making it as one. So then we're gonna have like one retained earning, which is retained earnings of Liam. So that's why this should not be like included. That's why adjustments is needed, and it's to cancel out the accounts. Now, as for dividends, we still have both of them have like negative amount of dividends, which means that uh, they convert their money into cash, to pay to their um, to the share to the investors in a way, shareholders. I'm sorry. And so in the case of Theo, since they're also paying like 500 to Liam, that means that we don't need to record this as dividends because it already goes to the Liam, right? So that we don't need that. That's why I cancel it here. As for the Liam, we still have to count dividends because they're actually paying to Liam's like shareholders, and not Theo, right? And that should sum up to this. Okay, now for the balance sheet, we have cash. These numbers are the same, pretty much the same as the case, the numbers provided in the case. However, there are certain adjustments on dividend receivables and investment in Theo. Here is adjusted and it's cancelled because uh, we try to collect the dividends, because dividends are already collected. So then there's no need to be uh, to be there's no need for receivables anymore because it has already been paid. So it's just like adjustments like that. As for the investment in Theo's account, it is cancelled because in a consolidated statement, you have consolidated everything. You have put everything together. What this means is that if you have assets like this and like this, those two should be included as like an aggregate, assets of the parent company, Liam, right? So that's why I just for an example, you want to add these two together and so on and so forth to the bottom. And when you add that, the amount of assets that we get from Theo as we acquire them is the same as the investment in Theo account. So that's why we have to cancel this account, because then again, if we don't cancel, it'll be double, because this amount is basically equal to like this amount, the assets that they have. And as for goodwill, we have calculated goodwill before. Goodwill is considered in the assets account. I think I've talked about like the definition and everything about goodwill in the previous video. But that's goodwill, and we just put goodwill in, adding to our asset account, and we should have a total asset of this amount. And lastly is for the accounts payable. Again, it's the same as the case, but there are some adjustments, right? So first of all is the payable, dividends payable. You see how I eliminate the receivables, and then I also reduce the payable, right? So it's the same amount. This gets canceled, this gets canceled too from the account, and this is the same. Capital stock, maybe. Yeah, so this is also like just the idea of transferring your everything from the company, from the subsidiary to the parent, including capital stock as well. So that's why you have to like cancel it. So you have just the capital stock of Liam, because now this belongs to this, right? And then you have, lastly, you have this non-controlling interest from January 1 and from December 1. So this is the initial non-controlling interest, and adjustments were made, yes, due to the change in like non-controlling interest, because like over time it would get updated as they produces net income, or maybe in other cases for other companies, maybe sale of like assets and so on and so forth. And so for that kind of situations, we adjust the non-controlling interest account, and in this case the adjustment is like positive, so then we add that to 2700, and then we should get like total liabilities and equities of this amount, which is equal to total assets, right? Oh, another thing I haven't mentioned yet is maybe I like totaled this with this, but that's just like for my calculation. You know what, I don't actually need to include this in the table, so I'm just gonna delete it. But yeah, that's for my answer. I think this should be the consolidation worksheet. You can let me know if I did anything wrong. I hope I did everything correct. And I am really looking to learn more on like this topic, because this is like, gotta be honest, it's like it's a lot. It's a lot to learn. So, yeah. Just to recap, first you want to calculate the goodwill and non-controlling interest by using the 100% fair value method. That's how I like to call it. Aside from that, you also want to calculate the net income share and the non-controlling share, basically dividing, separating between what we own as the parent and what we don't own as a parent, which belongs to the non-controlling. And then you can make adjustments according to that. And you can also make adjustments to omit accounts that should not be in the consolidated statements, such as income from subsidiaries or investments in subsidiaries. So those kind of accounts, and you instead replace it with, in this case, with actual income, and in the case of investment in subsidiary, you place it with the assets, because you get assets from your investment. So that's kind of the conclusion from what I can take. Yeah, that is gonna be it for the video. I will see you in the maybe next video about chapter 5. Okay, see you.